Friends, thank you for being here today. It is a privilege to speak with you, not just as investors or observers, but as individuals who have worked decades to build your legacies and secure your financial futures. We find ourselves at a moment in history that feels strangely quiet on the surface, yet structurally violent underneath. You might be looking at the stock market, seeing the daily fluctuations, and wondering why the traditional signals, the ones that guided us through the 80s, 90s, and early 2000s, seem to be misfiring. What if I told you that the silence you feel in the markets is actually the sound of a foundation crumbling, not with a bang, but with a slow, grinding shift that will redefine how we value everything we own? And perhaps more importantly, are you prepared for a world where the United States dollar is no longer the only sun around which the global economic solar system revolves? These are not comfortable questions. They are not the kind of questions you will hear on the nightly news, which is too busy focusing on political theater to notice the tectonic plates shifting beneath our feet. Today, we are going to pull back the curtain on a phenomenon that I call the global repricing. We are going to combine 5 critical threads of information, from the hidden maneuvers of the BRICS nations to the internal confusion at the Federal Reserve, from the code red affordability crisis facing Main Street to the specific stocks that might survive the turmoil. We are going to construct a unified picture of why the end of the US dollar as absolute hegemony has begun, and how we, as prudent Americans, can navigate this transition without fear, but with eyes wide open. Let us begin by examining the invisible shift happening right before our eyes, where the evidence is arguably worse than you think. If you have been watching the markets lately and felt that things have gone oddly quiet, you are not imagining it. The holidays often take the noise out of the system, creating a lull that masks momentum, but make no mistake, something pivotal is happening. The United States dollar has just logged its worst week in 6 months. While the media might frame this as a temporary blip, the data suggests we are witnessing a structural change after decades of dollar dominance. We need to look closely at the hard numbers of this decline, because numbers do not lie, even when politicians do. As we head into 2026, the US dollar index is on track for its weakest year in more than a decade. Through September of 2025, the greenback was down nearly 10% against a basket of major currencies. When we drill down into individual pairings, the picture gets uglier. The dollar has fallen more than 13% against the euro and the Swiss franc. It has registered a decline of over 6% against the yen and more than 5% against a basket of major emerging market currencies. To be clear, a 13% drop against the euro is not a minor adjustment. That is a repricing of global money. It means your purchasing power abroad and the value of your dollar-denominated assets relative to the world has shrunk significantly. You might be asking yourself, why is this happening now? So, what caused such a sharp sell-off in 2025? It wasn't just one smoking gun. It was an accumulation of structural fractures. Some of this pressure has been building for years. We all know that rising U.S. debt levels have been a constant concern. Those worries intensified with major fiscal packages, like the so-called Big, Beautiful Bill, that expanded deficits even further. For decades, the global assumption was American exceptionalism, the idea that the U.S. economy consistently outperforms the rest of the world. That belief is eroding. We are facing tariff uncertainty, questions about policy consistency, and fears regarding the Federal Reserve's independence. When you add geopolitical escalations, such as the recent seizure of oil tankers, which we will discuss later, it takes a toll on the global perception of U.S. stability. The most alarming signal, however, is not the price of the dollar itself, but the behavior of global investors. For the first time in a long time, we are seeing global investors increasing their hedging of U.S. assets. In the past, confidence was so high that foreign investors would leave their dollar exposure unhedged. That trend has reversed. This is a big red flag. It tells us that while the world still holds dollars, they no longer trust them implicitly. Investors are wrestling with the question, is this the beginning of a long-term collapse? The evidence, slowing U.S. growth, massive fiscal deficits, and sticky inflation, points to continued pressure. The foundations of dollar dominance are eroding. While it remains the world's main reserve currency today, the monopoly is over. Alternatives are arriving, not in theory, but in practice. This brings us to the external threat, specifically the 8 days that rewrote financial history. While Washington was distracted by political infighting and the holidays, a financial revolution took place. It happened over a span of just 8 days, December 9th through December 17th, 2025. These 8 days accidentally, or perhaps deliberately, revealed the entire blueprint for ending dollar dominance. The Western financial press largely ignored these events, burying them on the back pages. But we must pay attention because this was not diplomacy. This was financial warfare. To understand the magnitude of this shift, let's walk through the timeline. On December 9th, 2025 in Addis Ababa, Ethiopia launched its National Digital Payment Strategy. To the casual observer, this sounds like boring bureaucratic news. It is not. Ethiopia unveiled an instant payment system operated by EthSwitch. This system is designed for person-to-person transfers and, critically, cross-border transactions in local currencies. Ethiopia Merwi's S strategy document explicitly states a medium-term goal for 2027-2029 to integrate with BRICS payment systems. This means Ethiopia can eventually trade with India in rupees or Russia in rubles, bypassing the dollar, bypassing SWIFT, and bypassing New York banks. Just one day later, on December 10th, Indonesian President Prabowo Subianto met with Vladimir Putin at the Kremlin. The official readout discussed energy and defense. But if you read between the lines, they were discussing free trade zones and settlement mechanisms. Russia has been locked out of the dollar since 2022. Indonesia is a key BRICS member. They are not trading in dollars. They are using rubles, rupiah, and yuan. This meeting was a stress test of the bypass mechanisms before they scale up. Then, on December 12th in Brasilia, the BRICS Sherpas met, and Brazil handed over the chairmanship to India. This transfer of power was symbolic, but also strategic. Brazil focused on challenging the IMF and World Bank. India is taking over with a mandate for resilience, innovation, cooperation, and sustainability. In plain English, resilience means insulating BRICS economies from dollar-based sanctions. Innovation means building non-Western payment rails. Finally, on December 16th, we saw the smoking gun. Indian Prime Minister Modi landed in Ethiopia, the first visit by an Indian PM in 15 years. This was the final piece of the puzzle. India committed to sharing its digital public infrastructure with Ethiopia. India is exporting its UPI, Unified Payments Interface, technology. Now, consider why this matters so deeply to you and your portfolio. Connect the dots. Ethiopia builds the rails on December 9th. Modi arrives on December 16th to install the software. Now, African nations can settle trade with Asian nations in their own currencies. This is the death of dollar hegemony by 1,000 cuts. It isn't a dramatic announcement or a sudden collapse. It is millions of transactions flowing through systems that the Federal Reserve cannot see. The Treasury cannot freeze, and Western banks cannot tax with conversion fees. The sanctions placed on Russia in 2022 accelerated this. By cutting Russia off, Washington forced them to build workarounds. Now those workarounds, tested and operational, are being franchised to any nation that wants to escape American financial influence. The dollar isn't dead, but its use is no longer inevitable. The network is live. We must now confront the silent exodus happening in the global treasury markets, a phenomenon often overlooked but critically dangerous. While the headlines focus on the visible machinery of BRICS, there is a much quieter, yet perhaps deadlier erosion happening in the plumbing of the global financial system, the sudden shift in how the world treats U.S. debt. For generations, U.S. Treasury bonds were considered the risk-free asset of the world. Foreign central banks and sovereign wealth funds bought them without hesitation, often leaving their positions unhedged. To understand why this matters, you have to understand what unhedged really means. It means trust. It means a foreign investor in Tokyo or Frankfurt buys a U.S. asset and does not feel the need to buy insurance against the dollar dropping in value. They trusted that King Dollar would remain strong enough that the currency risk was negligible. That trust granted the United States what economists call an exorbitant privilege. We could borrow cheaply because the world had an insatiable, unhedged appetite for our debt. But as we moved through 2025, that dynamic broke. Global investors began aggressively increasing their hedging of U.S. assets. This is the big red flag that few are talking about. It signals that while they may still hold our paper for now, they no longer trust our currency. They are buying insurance against a dollar collapse because they see the writing on the wall. Why the sudden loss of faith? It is the cold, hard math of our fiscal reality. Rising U.S. debt levels have transitioned from a long-term concern to an immediate liability. The recent fiscal packages, which expanded deficits even further during a time of supposed economic recovery, have spooked the bond vigilantes. When you combine this fiscal irresponsibility with geopolitical weaponization, like the seizing of assets and sanctions, you tell the world that U.S. debt is not just an economic instrument, but a political one. This creates a vicious feedback loop. As foreign investors hedge their exposure or step away entirely, the cost of funding America's massive debt pile rises. We have to offer higher yields to attract buyers, which increases our interest payments, which increases the deficit, which requires more printing, which further devalues the dollar. This is the debt trap. The silent exodus from unhedged U.S. Treasuries is the market's way of voting no confidence in our ability to manage this trap. It is the invisible force driving the global repricing, ensuring that even if the Fed tries to save the day, the global capital flows are already moving toward the exits. I want to pause here because this is the crux of the issue, and I really want to hear from you. Do you believe the U.S. government has the political will to reverse this debt spiral? Or do you think this global shift away from the dollar is now inevitable? Please leave a comment below with your thoughts. I read them all, and I am genuinely curious to see where you stand on this critical debate. While the BRICS nations are building a new house and global investors are hedging their bets, our own domestic dilemma is that the Federal Reserve is walking a tightrope. While the BRICS nations are building a new house, our own house is showing cracks in the foundation. We turn our attention now to the Federal Reserve, the institution charged with protecting the value of our currency and keeping our economy afloat. We recently witnessed a highly anticipated interest rate decision. We must recognize that this was actually a hawkish cut. This implies that while they lowered rates, they are signaling they might stop soon. They are tapping the brakes, not slamming on the gas. Why the hesitation? Because the Fed is flying blind. Due to recent government shutdowns, the Federal Reserve has been forced to make decisions with delayed data. They are missing critical reports on employment and inflation. Imagine trying to land a 747 in a fog bank with half your instruments turned off. That is the position of Jerome Powell and the FOMC, Federal Open Market Committee. Furthermore, for the first time in years, the committee itself is fractured. For years, Fed votes have been unanimous or close to it. That unity has shattered. In the recent decision, there were 3 dissenting votes, the most significant dissent we have seen in 6 years. Some members, the doves, like Governor Stephen Miron, argued for a larger half-point cut, believing the job market is collapsing and needs immediate rescue. The hawks, on the other hand, voted for no change, terrified that inflation, which remains stuck above the 2% target, will roar back if money gets too cheap. This division is dangerous. It signals to the market that the experts do not agree on the diagnosis. If the doctors are arguing over whether the patient has a fever or hypothermia, how can we trust the treatment? Looming over all of this is a growing political shadow. Tensions between the White House and the Federal Reserve are at a boiling point. President Trump has made no secret of his desire for lower rates and has even floated the idea of replacing Jerome Powell when his term ends in 2026. The name Kevin Hassett has emerged as a potential successor. For us, as investors, a politicized Fed is a terrifying prospect. The Fed's credibility rests on its independence, its ability to make hard, unpopular choices to kill inflation. If the market believes the Fed chair is simply doing the bidding of the president to juice the economy before an election, bond yields will spike, and the dollar will suffer even further. The Fed's own projections for 2026 confirm this uncertainty. A majority of the committee members indicated they expect very few rate cuts next year, perhaps one or none at all. This contradicts the market's optimistic pricing. Wall Street is betting on cheap money. The Fed is saying, not so fast. When Wall Street's fantasy collides with the Fed's reality, volatility is the only guaranteed outcome. This brings us to the disconnect in the real economy, where Main Street is facing a code red. We have discussed the dollar abroad and the Fed in Washington. Now, let's talk about the reality on the ground, the economy that you, your children, and your grandchildren are living in. There is a massive disconnect between the stock market and the real economy. We are living in a K-shaped recovery. If you own assets, stocks, real estate, a 401k, you represent the top leg of the K and are likely doing okay. Asset prices have remained elevated. High-income households are still spending, driven by the wealth effect of the stock market. However, for the average American wage earner on the bottom leg of the K, the situation is dire. We are witnessing a profound affordability crisis. The statistics are grim. Credit card delinquencies have hit 12%, a 15-year high. Auto repossessions are surging, approaching 2 million vehicles annually. This tells us that the working class is tapped out. They have burned through their pandemic savings and are now drowning in debt just to keep the lights on. We are seeing a bifurcated retail sector. High-end stores like Bloomingdale's are seeing sales growth, while mass-market retailers like Macy's are struggling. This confirms that the consumer base is fracturing. The engine of the U.S. economy is consumer spending, and half the cylinders are misfiring. Adding fuel to this fire is the tariff wildcard. The Supreme Court is currently hearing arguments regarding the constitutionality of new reciprocal tariffs implemented by the administration. This is a massive variable. If the tariffs stay, we likely see continued goods inflation as companies pass these costs on to you. If the tariffs go, it could cause chaos in the markets as billions in collected fees might need to be refunded, and domestic industries lose protection. Prediction markets are currently forecasting a 75% chance the tariffs are struck down. If that happens, expect immediate volatility in retail and manufacturing stocks. As if economic fragility weren't enough, a new geopolitical spark has ignited involving Venezuela. The U.S. government recently confirmed the seizure of a large oil tanker off the coast of Venezuela. President Trump called it the largest one ever seized. This is a serious escalation of tensions. Why does this matter to your portfolio? Oil. Venezuela is a major oil producer. Seizing tankers restricts supply and increases geopolitical risk premiums. Oil prices rose immediately on the news. Higher oil prices act as a tax on the consumer. further squeezing the code red households we just discussed. It also complicates the Fed AS job. How do you fight inflation when energy prices are spiking due to military actions? If you are finding this analysis helpful and want to stay ahead of these complex economic shifts, please take a moment to like this video and subscribe to the channel. Your support helps us continue to bring you this kind of in-depth reporting that you won't find on the mainstream news. So, how do we pivot? Let's discuss an investment strategy for surviving this transition. We have painted a picture that is admittedly concerning: a repricing dollar, a rising BRICS alliance, a confused Fed, and a struggling consumer. But as seasoned investors, you know that chaos creates opportunity. The goal is not to panic, the goal is to pivot. The crash narratives on YouTube garner millions of views, but we must be rational. While the risks are real, the data suggests we are in a market correction, a drop of 5 to 10%, not necessarily the start of a total systemic collapse, at least not yet. However, the strategies that worked in the last 10 years may not work in the next 10. Here is how we position ourselves for 2026 and beyond. First, we must reconsider gold as an insurance policy. In a world of currency debasement, gold remains the ultimate hedge. However, a word of caution: do not fall for the fearmongers trying to sell you gold at massive premiums. The reality is that gold does not produce cash flow. It doesn't pay a dividend. It is insurance, not an investment engine. The strategy here is simple. If the dollar continues to weaken, as the charts suggest, gold becomes more popular. But you must be skeptical of those screaming, "buy gold now," because the world is ending. Own it as a diversifier, perhaps 5-talk 10% of a portfolio. But do not dump your entire nest egg into shiny metal. It can swing wildly with speculative sentiment. Next, we look to equities and buying the dip in the new economy. Despite the tech sell-off, the artificial intelligence, AI revolution is not over. It is merely moving from the hype phase to the build phase. Do not just look at the flashy software companies. Look at the plumbing of AI, the infrastructure. Companies like Supermicrocomputer, SMCI, and CoreWeave are building the data centers and servers that power AI. Even with recent pullbacks, these companies are growing revenue at astronomical rates. SMCI, despite its volatility, is trading at valuations that look attractive if you believe the AI build-out has years to run. Simultaneously, look toward value in safety sectors. Energy and real estate are traditionally safety sectors. If inflation remains sticky and the dollar drops, hard assets like real estate and commodities, energy, tend to perform well. They are currently in value territory, meaning they haven't been bid up to the moon like tech stocks. We must also address the crypto paradox, specifically stablecoins. This is a topic many over 60 tend to avoid, but we must address it because it is part of the global repricing. I'm not telling you to buy Bitcoin and hope it goes to the moon. I am telling you to look at stablecoins and the infrastructure behind them, like Ethereum. We are seeing a shift to a new era in digital payments. Stablecoins, digital tokens pegged to the US dollar, processed over $10 billion in payments in a single month recently. The play here is that this infrastructure is becoming the digital SWIFT. Investing in the networks that facilitate this, like Ethereum trusts, or companies involved in this plumbing, like Circle, is a way to bet on the technology of money, changing rather than just gambling on the price of a digital coin. Finally, fixed income remains our boring but essential anchor. With the yield curve behaving strangely, where do you park your safe money? The advice from many analysts is to stick to intermediate-term bonds. Short-term bonds have reinvestment risk, rates might drop. And long-term bonds have volatility risk, rates might spike if inflation returns. The belly of the curve offers a balance. Stick to high-quality corporate bonds and treasuries. In a code red economy where bankruptcies might rise, you do not want to be holding junk bonds of companies that might go under. To conclude, let me offer you a roadmap for 2026. Friends, the era of the unquestioned US dollar dominance is fading. It is being eroded by the innovation of BRICS nations who are tired of American financial control. It is being eroded by our own spiraling debt and the politicization of our central bank. It is being eroded by an economy that has left half the population behind. But fading does not mean disappearing. The dollar will not vanish tomorrow. It is being repriced. For you, the American investor, this means the rules have changed. The passive set it and forget it strategies of the last decade, where you just bought an S&P 500 index fund and ignored the world, may result in stagnation. We must be more active. We must understand that owning non-US assets is no longer unpatriotic. It is a necessary hedge. We must understand that gold and perhaps even digital assets have a place in a portfolio designed to survive currency devaluation. We must watch the Federal Reserve not just for what they say, but for what they do, and vote with our wallets accordingly. The global repricing has begun. The evidence is worse than the mainstream media thinks, but for those of us paying attention, it is not a catastrophe. It is a signal. It is a signal to diversify, to harden our assets. and to prepare for a world where the dollar is just one of many options on the global stage. Thank you for your time, your trust, and your commitment to understanding the truth behind the headlines. Stay vigilant, stay diversified, and I look forward to navigating this brave new world alongside you.